Whenever you talk about the consumer, you have to look at what is happening with wages. And I thought this was a really good chart looking at the share of U.S. workers who lost pay or income in the prior week. And you can see that shrunk. And that's a good thing when you think about where they are in spending and their ability to compensate for some of these higher prices. But at the same time, it's a problem for the Fed because this is showing that, again, they indirectly want people to have their income come down, so then they stop buying, and when they stop buying, prices come down, and you have this feeding effect, which is why they try so aggressively to avoid wage price spirals. Because once you get that spiral upward, it's really hard to break, as we saw with Volcker in the 80s, taking rates to the moon. So the share of Americans reporting lost pay or income fell from 9.7% in February to 9.5% in March, reflecting the resilience of the U.S. labor market. That resilience is great if you're looking at it from economic strength, but it's a problem when you look at it from the Fed's perspective, which wants to come up with really any reason to bring pricing, to bring rates down. But the resilience of the labor market is the opposite of what they would need to see to bring rates down. Again, kind of feeding into where these problems lie. The incidence of income losses was relatively low across industries tracked by the Morning Consult Economic Intelligence. So then when you start looking at household excess savings, and it's looking to be when they talk about likely to be gone by that 2023, it's because you look at the gap between the two. And it's one of the things is obviously it's overweighted to the top side. A lot of people on the bottom end of the spectrum or the quintiles are already seeing that pull down. So again, it's a good number to look at, but there are nuances with it. But this is providing some of that support for spending and for those pieces. But as you start getting towards the end, and as we talked about on last week's show, you're seeing people already saying over the next 6 months, they're not going to amusement parks, to hotels, to museums. And you're starting to see that pressure mount on some of those different spending trends. So then when you start looking at, well, how does that impact the economy further? Well, the spread between new orders and production in ISM manufacturing reversed lower in March, which bodes well for further decreases in inflationary pressures. And that's a good thing. You want to see some of those adjustments to bring some of that pricing down. Prices paid, which is the blue, within the ISM manufacturing also reversed lower in March, while supplier deliveries also ticked lower, and now at the lowest since the great financial crisis, which, as we've been talking about going back through the last couple of weeks, is that we're seeing shipping get more normal on terms of pricing, but it's a mixture of there's less stuff to move and more people to move it. And so it's good and bad at the same time, because you're going to see another shakeout when you start looking at the trucking industry. But again, all of these are leading in the right direction for where we are. But remember, this is just manufacturing. Services has gotten better, but still expanding at almost 60% or 60 on the PMI scale. Construction spending for private residential space continues to fall, with a year-over-year percentage change of 5.7%, falling negative 5.7% in February, hovering in recessionary territory. But it's been here before without that formal recession. And the reason why is because you look at the rate year on year. But then, so that again, year on year is, and this is where you can play with numbers and math. The year on year looks bad, where you're like, oh my God, we're falling 5.7%. But then you look at the actual number at the top, that blue line, where it's like, okay, so we went from 0.9 to 0.85. You're like, how slow is it? How problematic is it? And that's when you start looking at the numbers on the U.S. private construction spending. Non-residential has flatlined, residential has come down, but you see the massive gap. So our whole thing is there's still way more room for this to continue to contract and meet somewhere in the middle, because this is going back to 2007. This is the widest we've been. And if you go prior to 2007, we've widened out like this. And you can see that the residential typically collapses down and you see something, meeting somewhere in the middle. Even though the ISM manufacturing PMI ticked lower in March, the number of industries reporting growth moved a bit higher. And you can see it's not a drastic move, but again, it's that bounce up. And one of the things that we've been talking about is that we're not going to get this bounce back to growth or this expansion, but we're also not going to continuously see a downdraft. It's going to be this sideways move from here on out where things really kind of bounce back and forth within a fairly tight band. Then when we look at some of the different pieces, real personal income growth is starting to ease again, with the 3-month annualized change falling to 1%, slightly below the long-term median and not yet in recessionary territory. So again, you're just kind of hugging this line, which is starting to kind of flatline, but you're still seeing a slowdown. That's still a negative growth trajectory when you look at it on a real basis. Personal savings rate continues to move a slightly higher from the recent low, an increase to 4.6% in February from 4.4. So again, you're still low, but you're just not continuously going down. And you can see even on this one, just on the both of them, the trajectory is just that sideways move with some of that, a little bit of a downward draft. And again, none of this is showing that the economy is going to explode, the consumer is going to be in Hoovervilles. It's just we're not in a good position, but we're not in a terrible position either, which is why the Fed is looking at this and saying, well, technically there's still there's still a chance for them to raise rates without creating this really bad downdraft, given some of these underlying pieces for the consumer, which is such a big component. But the food commodity costs have fallen, but are still elevated. 3 of the overall UN index's 5 categories are down from a year ago. But it's not like they're down in a huge way where you're going to get this massive saving grace. The United Nations is set to release its monthly report. Its price index, which tracks 5 major export food commodities, it fell for the 11th straight month in Feb to the lowest level since September of 2021 after surging to a record. So again, it was at a record, and you're coming down, but it's still coming down softly, which is not what you need when you start looking at the problems that we've been talking about on drought, on lack of availability. You know, sugar just reached a 6-year high. You're seeing more issues with wheat, which is what we've been talking about. And again, that's going to keep pressure on the underlying consumer, especially in the emerging market. U.S. inflation taking a bite out of income, allowing consumer purchase power to improve over the past 8 months. So when you start looking at the difference, the U.S. real disposable income and consumption, so consumption still outpacing that income level, which is, again, that drawing down that savings. But at some point, you're going to start to see that trend bend. And you're starting to see it starting to flatline, and you flatline first, and then you start to roll over, and then that roll can be fairly aggressive very quickly, especially if you think back to 2008, where all of a sudden the consumer was like, oh, it is pretty bad out, and then all of a sudden things just stopped, and obviously the bump in savings is buffering that a bit, but that goes away and has gone away very quickly. U.S. consumption by 3 main categories. You know, as we've been saying, it's services that is going to take over, so that durables and services is going to collapse into it. With U.S. real consumption services, you're still seeing we're well above what is the normal on that annualized basis going back to 2014. You're still at a very high level, and that's why there's still consumption, which is going to drive pricing, which is going to keep inflation, again, a bit more elevated. And that's where we continue to see some of those pressure points on that side, which is why when you look at February PCE inflation, it came in at 0.26 versus 0.57% in the prior month. And then the core came in at 0.3 versus the 0.52 in the prior month. But again, you're still moving in the wrong direction. You know, the view is that this should be coming down and actually moving into contraction, and it's not. And this is an important point for the Fed, because this is what they look at. February PCE inflation came in at 5% versus the estimate of 5.1. And then the core came in at 4.6% versus the estimate of 4.7. But again, back to that point, that flatlining, which is what we continue to see and what everything is really trending towards. Personal income came in at 0.3 versus the estimate of 0.2. And then when you look at just the different levels, again, things are moving in a steady rate. And this is leaving more opportunity for the Fed to continue to increase rates. And then through the end of the fourth quarter of last year, employee compensation as a percentage of corporate gross value add rose to 57.6%, up from the recent lows. But they're still seeing less getting passed to the consumer. And this has been a continuous trend. This chart only goes back to 2000, but it's been a trend through the 90s into the 2000s, which is a pressure point. Vacancy has been plaguing commercial real estate market for the past few years, and you can see it's actually moved back to the highs. And when you look at even before the housing crisis, this is the biggest vacancy we've had. And even after a small dip, now you're going back up, and it's just because you have leases expiring, and people are like, I don't need 3 floors anymore. I need 1. And you're just seeing that consolidation, which is creating more of that pressure on the commercial real estate, which moved back to the highs of 18.7%. Construction spending for residential home improvement is well off peak. And again, you're seeing people are looking to stay in their homes, but make it a bit more comfortable. And that's something that is starting to change. Home Depot talked about it in their earnings report, and you're starting to see some of these drift lower. And then the February factory orders came in at negative 0.3% month on month versus flat in the prior month, and then the year-on-year trend has softened to 2.6%, back to where it was in February of 2021. So again, factory orders are moving in the wrong direction as we do have inventories building. And then, as we said, on the new order side, came in at negative 0.7 versus the estimate of negative 0.5. And as we said, you flatline, and then you start to see a sizable roll. And this is the leading indicator that goes, this drops before retail sales drop, because you're starting to see some of this, some of these slowdowns and some of these pressure points. And that's where you see another drop to the downside, another pressure point. And this is the leading edge of where retail sales are going to be, because the companies are seeing it. They're not ordering as much because they're seeing inventories build, because they're seeing sales slow. And that is some of the different feeding down, which is what we're seeing on the consumption side. And then now, as you see here, and the mostly decreasing is the important one to watch, because when you look at home prices, still half of home prices in the US haven't fallen. And then 23% have started to fall. And the thing that we're talking about is that on average, that yellow is going to shrink, and that green is going to shrink, and then that, let's call it orange or red, is going to start to push over. And it never happens quickly, especially in housing. But when you look at, and as we always show, home prices versus wages, the gap is so wide that you're just seeing a slowdown in underlying activity. As you can see here, when you look at the mortgage collapse, look at mortgage applications. Mortgage applications to buy a house just dropped to 39% year on year in March. That was the worst March performance since 1995. And it's going to be difficult for the recovery, because when you look at the banks which were they were waiving income proof, they were waiving engineering reports. Now they're getting stricter again, and that's going to make it much harder for people to get applications. And that's why you've seen that pivot to apartments versus housing. And that's why, when we've talked about it before, apartments are pushing the highs that we saw in the 1970s. But then look at the collapse that followed that. And that's where we see another pressure point, with 1.1 million apartment units currently in construction, construction or permitting, 60% higher than pre-pandemic, double the peak set in the 2007 bubble, which is obviously bad news for real estate investors, because it means lower rents are coming as more volume or more availability comes to market, which is some of these different pressure points that we've been talking about, which is good when you think about inflation, because as rents come down and owner's equivalent rent come down, that brings the inflation calc down. But because of supply chain issues, because of delays in construction, because of all of these issues, it's taking a lot of time, which is why this is the most ever recorded that we have in terms of completed builds and construction. We have such a wide gap, which is still going to take time to close. And that's what we have for you at the end for the US. In the next segment, we're going to go deeper into Europe and what some of the pressure points are that the ECB is going to have to watch.